Good morning, ladies and gentlemen. In this video, we will complete the previous video when we were talking about the risk management. Risk management is a part of money management. And as a simple explanation, we said that risk management is the dealing about losses and money management is the dealing about the profits. We will take a deeper look in this video in order to understand better this topic. So let's try to remember what we were discussing. So money management is a set of rules that helps to maximize the profit and minimize the losses, and generally speaking, to grow the trading account. Why? Because we always want to reduce the risk, but we want also to maximize the profit. And we have always to take care about the benefits of the money management, because money management it is evident that it is useful. Okay. Also, a kid can understand that it's so useful that we must use it. But beginners in trading are more involved in technical analysis and trying to spot the perfect entrance, okay, and are less dedicated at money management, because money management may be boring or may be useless or whatever. But without proper money management, we cannot become profitable traders. Easy as that. So remember, in the risk management, we try to avoid losses, but we have to accept the risk, no pain, no gain, trill and chill, taking on the chin, whatever, okay? But we are professionals, so we are not stupid. We have to join strategy to management. Not strategy only, but strategy to management. Because if we have two different traders, and one has an incredibly good strategy with the 90% of winning, okay, but without any money management, and the other one has just, as an average Joe, has a good trading strategy with a 50% of winning, but he is using the best money management strategy and rules, at the end of the month, the second will be probably more profitable. But because the first one, that is the smart one with 90%, the first one probably, likely, will lose all the profits on the 10% losing trades. This is the difference between having a good money management with a pretty good strategy, with to have an excellent strategy but without money management. We need only to calculate 4 different factors, okay? In order to have a successful trading, we have to take care of risk on each trade, the win rate, the risk to reward, and how many trades you take per month or per day or per whatever. That's it. We have just 4 numbers. If we understand these 4 numbers, everything will be simpler and smoother, okay? Because at the end of the day, we are not here for fun. We are here for business. We want to have a trading for a living. So we have to consider these 4 numbers. And here they are. The first one, the risk on each trade. We must control the risk on each position we take. And we accept a risk of the 1% of our account on each trade. In the previous video, we were talking about the 2%, but we were discussing about that. And in order to prepare you and ourselves to the next competition, we decide to lower the risk to the 1%. It means that when you place the stop loss, you have to calculate the risk to be the 1% of the capital. So the stop loss, we are using the ATR. Okay, stop loss is ATR by 1. So if you know the enterprise and you know the stop level, we have to determine the position side with the risk of the 1%, and our software is doing that. The second point is the risk-reward factor. Okay, the risk-reward is how much you make on winning compared on how much you lose on losing trades. So let's say that we are risking the 1%, but we try to have from 1.5% to an excellent 3% on our winners. So we risk 100 to make, for example, 200. Okay, so we accept the number of 2% in order to have the 1.5% on average. We will understand when we will be talking about the trailing stop, the break-even, the trailing profit, why the profit is not always around 2%, but maybe a bit less. The win rate is how many trades you win if you make 100 trades. Okay, so if you make 100 and you win 55, your win rate is 55%. And it's a very interconnected element with the risk reward. We always try to stay above the 50%. If we are above the 50% with a risk reward, let's say between 1.5 or 2% or above, we will be profitable trader. Okay, this is what you see. We can have a risk-reward ratio, let's say at 1. Okay, we try to be with a factor bigger than 1, and in any case we will be profitable. Here also, if we have a high win rate bigger than 50%, we are profitable. But if we are here with a low error, it will means that we will have an incredible pressure upon us. But if we have a high win rate with a high error, well, you will be a professional trader. This is the difference with the lucky ones, the losers, the lucky, and the professional. This is what I mean, okay? The risk reward may be negative. So let's say I'm accepting a 100 pips stop loss against a 1 pip take profit. And believe me, there are such kind of strategies in the market. But it means that I have to win the 99% in order to be profitable. So all the so-called negative risk reward is not for us. Okay, we try to have at least 1-to-1, 1-to-2, 1-to-3. So let's say 10 pips stop loss, 10 pips take profit, or 20 or 30, much better. Because in this case, the break-even will be the 25% or 33%. The higher, the better. So if I have 50 winning trades for 2%, I have a 100% profit. And 50 losing at 1%, I have 50% lose. Well, winning minus losing is 50%. It means that I increase my account by 50% in 100 trades. Okay? I increase the account by 50% in 100 trades. And the next question will be, how much time do you need to carry out these 100 trades? If we are working here at the end, at the border, okay, in this line, the 50%, it is not so comfortable, because if we go down to from 50 to 40% for any reasons, well, try to do something to go back to the 50%. Try to make small change in the strategy. Try to understand the time frame or um, your all the parameters of your strategy, because a slight adjustment may be the difference between a losing strategy or a break-even strategy or a profit strategy. So you have to understand also the circumstances of your trading and what you are doing. The goal is to stay 1 to 2, 10 pips stop loss, 20 pips take profit, it's 1 to 2. The break-even is 33%. If the win rate it will be around 50%, we have the edge. And the last number is the number of trades that we have. Okay, so let's do a bit of math. If our goal is to win more than 50% and to have more than 1% in error against the 1% that we are risking, if we can do that, okay, statistically speaking, the more trades you take, the more profit you will have. If we have one trade per day, it means 22 per month, 50% at 1.5. So it means that in 1 month, we increase the capital of 5.5%. If you make 2 trades per day, the profit will be the 11% per month. Of course, statistically speaking, okay? This is just a statistical exercise because we don't chase market. We don't open new trades just because I have to do 2 trades per day. I'm looking the opportunity according to strategy. Never, ever open multiple trades in a single hour, hoping to have a better profit. Actually, in our strategy, we are opening only 1 trade per time. We open the next one only when the first one will be closed. Because we have to maintain the risk control. So all the trades that we take must be a part of a strategy. If we are taking, the rubbish, at the end, the statistic will fail and the result will be halted. So the bottom line is try to have 1 or 2 trades per day subsequent to each other. We open one, we close the first, we open the second. Don't do 2 trades per time. You will understand much, much more when you will come in our offices in order to have the advanced money management course, the workshop, because in the office we will explain into details why we are working with 1 trade only and we are not accepting 2 trades in the meantime. Okay, the goal for us is to stay on average between 5 and 10% per month in profit minimum. In the workshop we will understand better how also we could increase. So now we have not to overcomplicate. The only things that matter is how many trades you win and lose out of 100. And this is the reason why you have the demo account. To test yourself, but to test yourself according to a strategy. Someone will say, yes, but the demo account is not the real one. The adrenaline is different, and the spread is not the very same of the market, but it's bullshit. What you have to do is to test your strategy and to test your approach to the market. And by chance, the trades that you win and lose out of 100 as a thumb rule rule of thumb, sorry. It will be the same number of trades, roughly, that you need to have a 10% gain monthly. So this is the reason why it's really, really, really pretty important that you can try yourself and prove yourself in the demo account with at least 100 trades for one strategy only. So the first conclusion is strategy is coming with management. Make hundreds of day trades using the same strategy. You have to know what is your win rate, what is your error, RR, and how many number of trades per day is your strategy producing. You can swap from demo to real only when you have hundreds of trades in demo. When someone is asking you how much is your win rate and your RR factor, you must be able to reply. Okay? Another rule, a basic one, when we are calculating the lot size, we always consider the balance. Okay, I told you that money management is not a matter of a terminal, MT4, indicators or whatever. It's much more about Excel. So let's say that we have a starting capital of 10,000 euros or dollar, whatever, and we have two different scenarios, all losing trades, sadly, all losing trades. I'm risking 1% of the starting capital. So it's risk 100, so it's going from 9,900, 9,800, 700, 600, 500, and so on, and so on, and so on. And you see that the real risk is increasing because the capital is diminishing. But if we have a remaining capital of 9,900, the 1% is no more 100, but it will be 99. It will be 98, it will be 97. In this case, the risk will remain the same, and the calculation in Excel will tell you how much you are risking. After 100 trades, you see, in the first case, you have a nice rounded 0 in your account because your risk was 100%. In the second case, you will still have 3,700 euros. Of course, now it's just an exercise, okay? It's a math exercise, but just to explain that the risk calculation has to be always to the remaining balance that we have and not to the starting capital. And the same, of course, also in the opposite scenario, if we have 100 winning trades at RR of 1.5. Of course, again, this is just an exercise. This is not reality, okay? But it's just to understand. In our first scenario, when we are investing the 1% of the 10,000, I'm risking 100, and I have a profit of 150. At the end, I will have a nice 150% return. But in this scenario, in this case, if I'm calculating the 1% of the balance and not the 1% of the starting capital, you see how the risk can increase and the profit at the end will be a nice 343% against the 150%. So we are using the balance in the lot size calculation and not the starting capital. What we are doing is that we are compounding the interests, we are compounding the profits, and we are maintaining the same risk, but we are achieving a better profit. In the next video, we will talk about the trailing stop, the break-even, and the trailing profit. And this is the reason why sometimes, the life is not black and white. So this is not always possible to have a risk of 1 and a profit of 2. Sometimes we have to accept a compromise and to have a 0.5, a 0.8, a 1, or whatever. And please remember that the advanced money management course will be in our office in the workshop. Thank you, gentlemen, for your attention, and let's talk later. Bye. Bye-bye.